Hi friends, Simit here from InformedTrades.com. In this video, I want to talk about the situation in Japan and the Japanese yen, give a little overview of the situation, provide an update, and talk about what I'm personally doing with my money and the trades I'm placing. So let's get started. Okay, key points. Japan has one of the most burdensome debt loads in the whole entire world. It also has budget and trade problems, which are related to its debt load. There's a demographic crisis going on, which is going to hinder its ability to grow its way out and pay off its debt. And lastly, we'll conclude with some trade ideas and targets, ideas for investors and speculators as to how they can participate in these trends. Okay, debt to GDP. So here's one thing you want to look at when evaluating debt levels is the country's economic capabilities. So here we're taking the debt level a country has that the government owes, divided by that country's annual GDP. And you can see that even when we account for Japan being a more developed economy than many other countries, it still has a noticeably higher debt burden, even when we normalize for that. Debt to GDP is over 220%, which is huge compared to everyone else in the whole entire world. Italy and the United States are second and third, and Italy is a little more than half. U.S. is probably less than half. You can see on this chart, this is from third quarter of 2014, so pretty up to date here. Japan's debt crisis basically is in a league of its own. Related to that is that there's still ongoing budget deficits. So this goes back to 2004. We've seen, every year the government is spending more than it's taking in. And it's the budget deficit is actually growing, right? Since 2010, we've seen it become more and more negative. So that's also a problem. The Japanese government is just spending too much, still borrowing more, debt is still growing, which, so you say one way that they may be able to deal with their debt crisis to raise interest rates. Well, if they raise interest rates, then the interest rates will be too much. There's really no room to raise interest rates. They're still taking on more debt. The interest payments will overwhelm the actual money that they could use for stimulus or for growing their economy or investing or whatever. So the country sort of has its back up against this wall, and really, especially with this spending more than it's taking in tax revenue, that's a big problem. So there's a lot of structural problems going on here as well that would be difficult to fix. Weakening current account. We have a whole bunch of videos and content on Informed Trades about the current account, but basically it relates a lot to trade and importing foreign investment, imports related to exports. Basically, when the current account is, looking at this chart, you can see that the current account starting in 2007, so basically at around the time of the financial crisis, Japan's current account started declining. We recently spent a little bit of time in the negative area after 2012 and a little bit in 2009 here. Current account, when it goes negative or when it's declining, it basically means that imports are growing relative to exports. The country is more dependent upon bringing stuff in than it is bringing more in than it is sending out. So internal resources are dependent. And when you have a budget deficit, you have a current account deficit, you're really struggling. You're really just not producing enough economically. That's basically what these signs indicate. And these are metrics to watch. So if the country can get its budget under control and eventually turn into a budget surplus, if the current account can start growing again, you get a more robust current account surplus like we had in the earlier part of this millennium. Those would be positive signs. But however, those signs are, as we can see on these charts, going in the wrong direction. Okay, demographics crisis. And this also relates to the budget and trade crises because simply Japan just doesn't have enough of a working population. This yellow line here, or this golden colored line, is the ratio of elderly people, the ratio of young people young enough to be working, as well, relative to that of elderly adults. And we can see that, that ratio is growing. So the number of elderly adults that the working people need to support through the social system and Japan's equivalent of Social Security and things like that is growing. That also creates burden. That also makes it harder for the government to reduce its budget because it has an elderly population to support. At the same time, or related to this, Japan's population, you can see this on the blue line, is now declining in absolute terms. So really since maybe 2011, 2012, that was sort of the top here. You can see it here. And now the population is declining. So you have a growing elderly population. You have fewer people in all and declining workforce. So you have a smaller number of people that need to create enough to get a trade surplus going, and an elderly population that, or it can also generate enough economic activity to support the elderly population that will need government assistance. So there's a demographics crisis, and this might be the hardest component to solve. As difficult as the budget and trade are to solve, as those are structural and systemic, the demographics may be even more, a whole new level of difficulty. So Japan's really in quite a situation here. Okay, so that leads us to the trade opportunities. Personally, the way I'm looking at this, here's a dollar-yen chart. It's a daily chart. The way I see this is, in light of Japan, a lot of people who have a view of a debt crisis, really there's no way out of it aside from currency devaluation. Japan will pay off its debt, but it's going to do so with devalued yen. This will be a result of the Bank of Japan printing more yen, and we haven't discussed that in this video, but if you look around and read around, and we've talked about our informed trades, the Bank of Japan is launching incredibly aggressive stimulus, basically means printing yen and boosting the Japanese stock market, buying Japanese government bonds, buying everything. This is ultimately increased the amount of currency in circulation, and whether that results in price inflation, I think it will, but there is definitely that chance. Also is, even outside of the fact that the Japanese central bank is just printing a lot of money, there's the issue of foreign debt holders may not want to buy, may withdraw their capital from Japan. And we talked a little bit about this in our video on deflation, where we're seeing many emerging market companies. Japan's not really an emerging market country, but a lot of emerging market countries are seeing capital exodus. They're seeing decline in economic activity, and investors are taking their capital out and putting it in the United States as more of a safe haven. This same sort of concept could apply to Japan, where investors become fearful of the country's incredibly high debt loads. And something to watch in that regard is foreign debt to GDP, external debt, is how it's more commonly referred to. External debt to GDP. I didn't want to put too much information in this video to make it overwhelming, but that's also something that investors and traders may want to monitor. And that also, external debt to GDP is also growing, which suggests that Japan is becoming more beholden to foreign debt holders, who in turn are more likely to dump their debt holdings if they deem the problem to be problematic or severe. Okay, anyway, back to the trading issue here. So obviously, the ideal point would have been to look at this range here. That would have been we had a really long accumulation period here in February, back at around 100. That would have been a great time to enter for a patient investor. I missed out on that, and then we really took off from there. What we did get was a bit of a pullback. So we pulled back 38.2% right around here. And once we had this pullback, that was when I entered. So I got in right around here. We're now a little over 120. However, I only have a really small position. And basically, the way I'm viewing this trade is I don't think we're going to get back to this red line ever again. I think the yen won't see 100 again. Dollar yen won't see 100 again. So, I put in a small amount of capital. And basically, I'm risking all of that, which is 1,800 pips. So let's say you had $1,000 you wanted to risk. 1,800 pips. You calculate the maximum position you can hold, and that enabled me to get a 4.5 to 1 leverage from this position. So you sort of identify what's the maximum amount of capital you want to risk, and then you take the biggest position you can. And you identify your stop, which I've done here as 100 or 100.11, basically right around there. I also do want to have a little bit of capital reserved in case we do see a bigger pullback. We might go back up to here, and then we might get a double top formation. We might come back down here. There's also an unfilled gap here, 112. That'd be a great level to enter at. So I've got more capital set aside in case we do fall back to these levels. So, enter in tranches is sort of a common idea for a long-term position. Enter here on this pullback, still have some capital in case we get a bigger pullback. And, the point at which I'll take my loss is if the market reaches 100, at which point, I was wrong. I didn't think we'd ever get to this point again. So I just admit that I was wrong and go on to the next trade. Okay, now in terms of target profit, I think 144, which is the high we saw around the turn of the millennium, is a pretty conservative target. So you can, if you have, in my situation, where I'm entered at 117 or 118, actually 118, I'm risking 1,800 pips, and I have 4 to 1 leverage, 4.5 to 1 leverage. It can end up being a pretty good trade if the market gets to 144. I haven't done the exact calculation, but that's the kind of trade that should be able to get me like 30% or so. And you have one trade like that a year, and you're doing great. So we'll see if that trade happens to be, it works out well for me. I even think 144 is actually a bit of a conservative target. If the market does get up there, I might be tempted to take some profit off and move to break even, still hold on for a larger profit as well. We'll see how price evolves and how things shape up. But that's basically it. Just wanted to share my trade, what I'm doing with dollar yen, my outlook on it. Any questions you have, any views you have that you want to share, join us at informedtrades.com. Best of luck in your trading, and we'll see you next time.